We were looking at the case where we have not just the central bank, but also the banking sector. In this case, we looked at how there are two ways which are equivalent in how we can express the financial market equilibrium. One is demand for central bank money is equal to supply of central bank money. The other way to go about it is in terms of how overall money demand is equal to overall money supply. And here we discussed how overall money supply is the money multiplier 1 by C plus theta 1 minus C. We looked in detail on the money multiplier times the supply of central bank money each. Now what you want to do is, we want to now plot the money supply curve in a graph with M on horizontal axis and I on vertical axis. Like we said, in this case, overall money supply is the money multiplier times supply of central bank money, where the supply of central bank money is fixed by the central bank and we assume C and theta are not affected by the interest rate. This is the fraction of total money demand held as currency. This is the reserve deposit ratio. So thus, the overall money supply is independent of the interest rate because supply of central bank money is just fixed by the central bank and in particular doesn't depend upon the interest rate. And resuming C and theta are not affected by the interest rate. So this means that overall money supply is independent of the interest rate, which means that if we have a graph with M on horizontal axis, then the supply of money being independent of the interest rate is drawn as a vertical line at M is equal to 1 by C plus theta 1 minus CH, because we have a graph where M is on horizontal axis, I is on vertical axis. And since this money supply is independent of the interest rate, so this means that in a graph with M on horizontal axis, the supply of money is drawn as a vertical line at M. So here's something that you should also keep in mind is, in the case where you do not have a banking sector, in that case, the central bank directly, perfectly, fully controls the money supply. But in the case where we do have a banking sector, the central bank directly controls the monetary base, but it can only indirectly control the money supply. Because like you said, the overall money supply is written as a product of the monetary base H and the money multiplier 1 by C plus theta 1 minus C. And we know this money multiplier is a function of the currency demand coefficient that households prefer, the required reserve ratio imposed by the central bank, and the excess reserve ratio the banks maintain. Right? If we go back, so we know overall money supply is 1 by C plus theta 1 minus CHS, right? So here HS is the monetary base, 1 by C plus theta 1 minus C is the money multiplier. C is the currency demand coefficient that households prefer. Theta is the reserve deposit ratio. It's the fraction of deposits bank hold as reserves. Now this will incorporate the required reserve ratio imposed by the central bank as well as excess reserves that banks hold. Now the central bank can only influence through the money multiplier through its control of the required reserve ratio, which is incorporated in theta. But otherwise, the money multiplier is out of the control of the central bank, as the central bank cannot control what C households prefer and the excess reserves the banks decide to hold, which is also a part of theta. So while the central bank can set the monetary base HS and can influence the money multiplier, it cannot directly control two components of money multiplier, C and the excess reserves part of theta. And therefore, it can only control money supply indirectly, which can vary for reasons independent of the central bank. As the money multiplier depends in part on the behavior of the public, how much currency they choose to hold, and banks of their decision of how many excess reserves they choose to hold. So the action of the households and banks affect the money supply in ways the Fed cannot perfectly control or predict. So in this case, where we do have a banking sector, the central bank can directly control the supply of central bank money HS, but it can only indirectly control the overall money supply because it's a product of the money multiplier and HS, where the central bank directly sets HS and it can influence the money multiplier, but it cannot control two components of the money multiplier, which is number one C, which is decided by households, and the excess reserves part of theta, which is decided by the banking sector. So thus it can only indirectly control the money supply because it cannot control two components of the money multiplier, which might cause the money supply to move in ways the Fed did not want move in ways that basically the Fed cannot perfectly control or predict.